I'm here with Ron Neufeld, who is with Intrinsic in Chicago. And today we're going to do an episode really to learn about what are QofEs, talking a little bit more about financial due diligence and what you as independent sponsors or borrowers should be thinking about when looking at a QofE, when to start it, when you should not do one, how much they should cost, and approximately how long it takes. So we're going to dive deep into this today. Ron, would you mind giving us a little bit of an overview about your background?
All right. Well, Intrinsic is a financial advisory firm. We're based in Denver. We were founded 10 years ago by Josh Cashman and Alex Hodgkin. Our professionals, there are 20 of us, CFAs and CPAs, and we provide business valuation, financial modeling, and M&A transaction support services. I joined the firm after 9 years in Deloitte's transaction services group to lead the advisory services practice. And in fact, most of our firm's professionals joined Intrinsic from large financial advisory or accounting firms.
Okay. And so what is the kind of the core of the services that Intrinsic does?
Mm-hmm. So the advisory services group that I lead, we provide financial due diligence, including quality of earnings services for buyers and sellers of companies that might be located anywhere in the U.S. and in any industry. Okay. We've completed engagements that involve targets from California to Virginia in a variety of industries, including software and online services, commercial recycling, financial services, oil and gas, medical services, and commercial construction at this point.
Okay. Is there any particular industry that you guys have really dived deep into? Or that you want to be known for?
Most firms who provide pre-acquisition diligence like ours are industry agnostic, which is to say that the kinds of services we perform tend to be fairly similar from one industry firm to the next.
How important is it to find, or what is the risk of going with the firm that's agnostic versus like a specialist, someone who's done, 100 reps in healthcare services? Or at what points does that really matter? Like, you really need a healthcare specialist, for example, or is that even for certain transactions?
Yeah, I don't think there are many firms out there there are firms out there that specialize in particular industries for M&A services, but there aren't such firms for every industry. So it's almost by necessity that if you're working with a firm whose people you regard well, that there's a pretty good chance they specialize in multiple industries. Okay.
So let's dive into kind of like the part of the market that you fit into, that Intrinsic fits into. What segment of the market do you really want to be known for in terms of maybe the size and shape of the QofEs that you're working on?
Sure. Our focus is on companies in lower middle market with a recurring EBITDA of about $1 million to over $5 million.
Okay.
Traditionally, our clients are private equity firms, and they're platform companies who might be doing add-on or tuck-in acquisitions to their existing portfolio companies. But we've also become a preferred service provider to search funds, for whom acquisition and modeling services, financial diligence, and valuation are all important. And what this means is that we work with search funds from the point prior to their execution of a letter of intent all the way through and beyond closing, when they may ask us to do a valuation to allocate the purchase price for the target company so that they have an adequate opening balance sheet wherein everything is mark to market, so to speak.
Okay. So it'd be good to come back to search funds, because I think it's a really interesting topic that, you focus on, that we at DebtMaven focus on. In fact, we just closed a deal in August for a search fund based in Chicago that acquired a San Francisco-based business services company. So search funds are important to both of our businesses. But let's go to the topic of QofE. Like, what is a QofE?
A QofE is a report prepared by a third party like Intrinsic that describes the results of financial due diligence services that they performed. The precise services performed in a specific engagement will vary depending on the particular needs of the client, but they will almost always include an analysis of earnings quality. And by that, I mean that they will analyze the company's EBITDA, and starting with revenue all the way down through operating expenses, looking for items that are non-recurring or not operational in nature, or that may relate to a part of the business that the client is not acquiring. In the case, for example, of a carve out of an entity from a larger seller. And in the objective of that analysis is to determine what normal recurring EBITDA is, and that's used as a basis for the client's financial modeling so that they can determine what they want to pay for the target and negotiate the purchase price, and determine a capital structure that is workable for the target post-acquisition, and also so that they can conclude that the future performance of the target will be adequate to service the acquisition debt.
Okay, so let's go through some examples that you have seen when you look at some, if you look at a healthcare services deal, or maybe a typical industrials deal, whatever you've done whatever you have a lot of experience on, what are some examples of non-recurring expenses and just some of these items that you have identified that you see in 90% of transactions or deals that people can think about?
Okay, so what is frequently the case is that a target company, and we'll look at history for a 2 to 3 year period, because you want to establish a base starting point for those forecasts that I mentioned. And so, for example, looking at top line revenue, it's often, not infrequently the case that a target company will have included in its recent history revenues from a customer or distributor that it's recently lost. And so what we'll do is we'll try to determine what those sales were for that company or a product that's been discontinued, et cetera, and pull them and the related cost of sales out of that historical performance, because it's not indicative of future performance. So if you want normalized performance, you need to understand where's the company now at the date you're doing your work, and does recent history indicate where it's going in the near future? So, for example, you might,
do you think that you see a lot of variance, especially in the lower middle market, with some of these mom and pop shops, when they might have, this line item, and whether that's a boat or an airplane on the expense side or on the revenue side, it's a particular thing, and they either didn't know or they hid that particular revenue stream and not really disclosing how true of a consistent revenue that is. Or am I just kind of mischaracterizing the lower middle market?
No, you put your finger on it, and that's where I was headed next with another example. Now, below the revenue line, you'll very frequently see, especially in family-operated companies, the owner's daughter's college expenses were put through the company's expenses, or that mountain condominium or boat or airplane is on the balance sheet, and the related costs of financing it and maintaining it are also run through the business's expenses. So we frequently find ourselves trying to ferret out, if you will, and make adjustments for personal expenses as well as one-off expenses. So, for example, perhaps the company incurred environmental litigation costs. That is a once in a generational kind of event for that company. Those are costs, including the fines, legal fees, and so on, that you want to add back to the historical performance in order to get a true understanding of go-forward recurring operations.
Okay. Is there an accurate generalization that we can make for companies that do $2 million of EBITDA, are family operated, and you're just like, all right, listen, from day one, you could just take off 10% off that EBITDA? Or do you have enough data points to make a generalization? Or am I just fishing for a headliner here?
Yeah, I think so. So I've looked at family operations where the volume and magnitude of personal expenses is very small. Mm-hmm. And ones where it's like that I alluded to with the airplanes and condos and the daughter's college expenses. But I would say it would be dangerous to assume that that all business operators follow the same, practices with regard to personal expenses. Instead, you need to jump into the details and ask a lot of questions.
So let's talk about first, when should a buyer start a QofE? And then secondly, can you walk me through the process in terms of a timeline to do a QofE?
Mm-hmm. So in most cases, a buyer should engage a firm like ours for QofE after they've signed the LOI, and shortly thereafter too, because you want to make sure that that you don't lose. Usually the LOI will have an exclusivity period, and you want to get as much work as you can do done in terms of financial, tax, legal, operational, technological diligence. You want to get all of that done before that period runs, and the seller becomes, weary of whether a transaction is going to close. So soon after the LOI is signed, and generally it takes about 30 days for smaller companies, provided that their operations are not unduly complicated and that their accounting records and systems are in reasonably good shape. Most small companies do not have CPAs handling their day-to-day accounting, so you expect to find problems. But if they're a complete wreck, then it can take much longer than the 30 days I suggested.
Okay, so are there like a pre-LOI checklist that buyers can use to help speed up that process? Or what are some of these items that they can think through before they come to you to become better prepared, either for you or to not even do the deal?
Right. What we find in most cases, and what I recommend to sellers of small companies, is that they engage their attorney or their tax accountant or their broker, if they're working through a broker or other advisor for the transaction, to say, yes, there are checklists, there are diligence request lists that companies use that have more, from one provider to the next, they have more or less the same information: financial and tax records, corporate records, contracts, and the like. And yes, it's highly advisable that they sit down with some advisor that they know from ongoing business experience to say, what does a buyer want to look at, and how do I organize this information? And a broker or an attorney can help them create a so-called virtual data room, wherein these documents are uploaded, scanned, or pushed up as Excel documents, what have you. And for many of these small companies that use QuickBooks, it's possible to get remote access to their accounting records so that we can do the work we need to do.
Okay, that's really helpful. So let's talk about situations where you do not need a QofE.
I would say the most common situation, there are certain specialized industries where a QofE is of secondary importance, like if it's a bank merger or something. But in general, the case in which a QofE is least useful is when it's a very young or startup business, because earnings may not be indicative of the next, say, 5 years. They may not have revenue at that point, at the time that they're getting ready to sell. It may have maybe a promise or an idea or a contract or a patent or something that is highly valuable and can be realized by a better, operator than the owner. So in those situations, a QofE is probably of little importance, but depending on where they are in their life, it might be useful to do an analysis of their cost structure and to do for somebody, attorneys and accountants in particular, to look at contracts to find potential exposures that might cost a buyer additional cash beyond what they're planning to spend to acquire the operations of the business.
Okay, so that's really clear. I mean, there makes sense for a lot of startups, right? It's completely different from a 30-year-old business that's going through a transition of ownership from maybe a family-owned business, and a search fund is coming in and buying it. So before we get to search funds, let's go into the cost. How much does it cost to do a QofE? What is the typical range for the side of the market that you're at? Maybe for larger transactions in, call it the, 5 to 30 million of EBITDA, and bigger. Like, help us to kind of put into context how much the different bands are. And I know it's dependent on the complexity, the size of the deal, but what's the general range we should think about?
Yeah, I think the general range is between, for very limited diligence, it can probably be done for $20,000. But generally speaking, I would say most transactions can be completed for fees between $25,000 and $35,000. 35 is a little bit larger, a little more complex business, perhaps with a little more so-called hair on it because of its history. It may have tried a lot of different things that didn't work out, and it takes time just to work through what those items are and what their effects on historical performance have been. The fees vary considerably by service provider. In general, smaller firms have lower overhead, and therefore they can afford to do these projects and are best suited probably to do projects involving smaller companies for smaller fees. At Deloitte, I regularly signed off on invoices that were 6-figure in size, but many of those were larger companies than those we focus on in the lower middle market.
Okay, and is everything it's sign the engagement letter, 25 grand, you're paid right now, or search funds in particular, cash strapped, or just smaller businesses, it might be a self-funded searcher, an independent sponsor. I know on the law firm side with, me as a startup or other early stage businesses, there's flexibility, but what generally happens? Is it first month is, quarter of the fee, or generally how are things kind of spread out?
Right. We're well aware of the situation you just described, Jordan, where the search funders, or especially self-funded searchers, are cash strapped. So if we're looking at a $25,000 project, we'll generally ask for a third of our fees with the signing of our engagement letter, a second third when we deliver our report, and the final third upon closing of the transaction, which means that if the transaction does not close, that we will roll our fee over. You're right. So reduce their costs in relation to their risk, and we'll roll our fees over, the remaining fees over into the next transaction if they promise to work with us on the next go round.
Okay, so you're almost taking, you're taking a risk with them, which means that you're also more selective on who you take on as clients.
Right.
And the viability of them doing another deal or them closing that one deal. I think I remember you saying it earlier on that you might do pre-LOI work with searchers. Did I hear that correctly? And what does that look like? When do you do it? And how do you actually filter that? Because you are putting work into a pre-LOI deal, high risk, no committed capital, inexperienced buyer. Why do you guys do that?
Right. Because we're trying to develop a relationship with these searchers. We have a financial model that is used for evaluating potential transactions and capital structures, and embedding the forecast results based on what the buyer thinks is going to happen pre-diligence. And that's in order to give them a preliminary sense whether the transaction makes sense for them. Mm-hmm. And we will provide several hours of modeling services gratis to our search funder clients, anticipating that if they reach the point of an LOI with a seller, that we'll be engaged to do due diligence work and potentially post-acquisition valuation work, as I mentioned before, in order to allocate the purchase price and create a GAAP-compliant opening balance sheet.
Okay. Is there a particular transaction that maybe you could walk us through on a no-names basis, maybe just talking about the industry, the general size and shape, and just kind of how that transaction looked like through their engagement with you?
Okay. So earlier this spring, we worked with a client, a searcher who acquired a commercial recycling business. And as soon as he entered into the LOI, our valuation people sat down with him to look at his model and help him identify potential risks in his capital structure. And then shortly thereafter, we began due diligence. And throughout that process, we kept our client informed of what we were seeing and what we thought were potential issues he might want to address in the ultimate purchase agreement. And within 30 days or 37 days, in this case, we had produced a draft report that the client was able to use to satisfy his investors and provide to the banks that were providing capital acquisition financing, so that they could feel comfortable that a independent third party had taken a closer look at the financial performance and condition of the company. This was a company whose financial statements weren't subject to regular audits. So there was, interest by everybody, including the buyer, his investors, and the banks, in having some other party take a deeper dive into their financial records.
And that whole process with you took 37 days. His engagement.
About 5 weeks.
Okay.
And from planning to final report delivery, and then the client came back to us later with a request for a bid to provide evaluation of the machinery and equipment used by the company, which was extensive in this case.
Okay. So this has been really helpful. Let's kind of bring it full circle and kind of summarize everything that we've covered. And we'll just do kind of a quick fire round for the audience here. So first off, 1 or 2 sentences, what is a QofE?
A QofE is a report that tells a client, and ultimately its lenders and investors, whether the company's earnings are sustainable and repeatable, and identifies potential risks. For example, hey, did you know that they have a contract with a supplier that's about to expire, and the suppliers told them prices are going to go up 10%.
Okay.
So it's meant to help them understand the repeatability of recent earnings performance.
Got it.
Okay.
And they should contact you when the LOI is signed. Typically, it's going to take around 30 days from soup to nuts, and it's going to cost around $25,000 to $35,000.
Correct. And typically closer to 25.
Okay. And how can people contact you, contact Intrinsic? What's the best way to reach out to you?
Oh, either by phone or email. Phone is 303-552-6771. That's my cell. Okay. And I'm Ron at intrinsicfirm.com.
Great. And it's Intrinsic Firm, and so it's Ron at intrinsicfirm.com. Awesome. That's all I got. Appreciate this and looking forward to reconnecting with you soon.
Thank you, Jordan.